Income machine or capital killer? Unveiling the Nasdaq 100 covered call ETF. Hey everyone, and welcome to Chat ETF. Today we're diving deep into a dividend darling that's got everyone buzzing, the QYLD, or the Nasdaq 100 covered call ETF. Is it an income machine pumping out consistent payouts? Or a capital killer lurking in disguise? We'll crack open the hood of QYLD's covered call strategy, exposing its pros and cons to help you decide if it's the right fit for your portfolio. But before we dig in, let's set the scene. Imagine you could earn regular income while still riding the Nasdaq 100 rollercoaster. Sounds too good to be true. That's the promise of QYLD. But like any exciting ride, there might be a few twists and turns you need to know about. So buckle up, ETF enthusiasts, because the next 30 seconds will give you a fast track to understanding QYLD's potential and pitfalls. Stay tuned. Question 1. How does the Nasdaq 100 covered call ETF, QYLD, select and manage its covered call options? QYLD employs a specific strategy for selecting and managing its covered call options, which differs from some other covered call ETFs that might write calls on individual stocks within the index. Here's the breakdown. Selection. 1. Index call options. QYLD focuses on writing call options on the entire Nasdaq 100 index, NDX, not individual stocks within the index. This simplifies their management and reduces tracking individual stock price movements. 2. Strike prices. The strike prices for the call options are typically at the money, ATM, meaning the strike price is close to the current market price of the index. This balances the potential for premium income with the possibility of assignment, early exercise by the option buyer. 3. Monthly expiration. The options contracts are typically monthly expirations, meaning they expire after 1 month. This allows QYLD to capture regular premium income and adjust the strategy based on market conditions. Management. 1. Active monitoring. The fund's management team actively monitors the options market and adjusts the strike prices and expiration dates as needed. This helps optimize the premium income while managing the risks associated with potential early assignment. 2. Rolling options. When options expire or are assigned, QYLD rolls the options by selling new covered calls with similar terms. This helps maintain the income stream and exposure to the underlying index. 3. Dividend reinvestment. QYLD distributes a high portion of its income, usually over 90%, as dividends to shareholders. This allows investors to benefit from the regular income generated by the covered call strategy. Important points here. 1. While QYLD aims to replicate the performance of the NDX, it may not perfectly track the index due to the covered call strategy. The capped upside potential from the call options can limit gains in bull markets, but the strategy aims to provide consistent income regardless of market direction. 2. QYLD is not suitable for all investors, particularly those seeking capital appreciation or who are risk-averse. The covered call strategy involves inherent risks, including potential early assignment and limited upside participation. Question 2. How does the specific covered call strategy employed by QYLD differ from other covered call ETFs, and how might this impact its performance? There are key differences between QYLD's covered call strategy and those employed by other covered call ETFs, which can impact its performance in various ways. Underlying asset. 1. QYLD writes calls on the entire Nasdaq 100 index, simplifying management and reducing tracking individual stocks. 2. Other ETFs may write calls on individual stocks within an index or sector, potentially offering higher premiums, but requiring more complex tracking and potentially exposing the fund to sector-specific risks. Strike prices. 1. QYLD typically uses at-the-money (ATM) strikes, balancing premium income with assignment risk. 2. Other ETFs may use out-of-the-money (OTM) strikes, offering lower premiums but higher potential upside if the underlying asset appreciates significantly. Conversely, they might use in-the-money (ITM) strikes for higher premiums but increased assignment risk. Expiration dates. 1. QYLD uses monthly expirations for regular income and strategy adjustments. 2. Other ETFs may use weekly, quarterly, or even longer expirations, depending on their specific objectives and risk profiles. Potential impacts on performance. 1. Capped upside. QYLD's ATM strikes limit its participation in significant index gains compared to other ETFs using OTM strikes. 2. Higher income. Monthly expirations allow QYLD to capture more frequent premium income compared to longer expirations. 3. Lower volatility. Writing calls on the entire index potentially reduces volatility compared to focusing on individual stocks. 4. Management complexity. QYLD's simpler approach requires less complex management compared to tracking individual stock calls. Overall, QYLD's strategy prioritizes consistent income generation over maximizing capital appreciation. It offers less upside potential than some other covered call ETFs, but aims for higher and more frequent income streams. Question 3. How does the Nasdaq 100 covered call ETF determine the strike prices and expiration dates for its covered call options? QYLD uses a dynamic and data-driven approach to determine the strike prices and expiration dates for its covered call options. Here's a breakdown of the key factors involved. Strike prices. 1. Benchmark. The primary reference point is the CBOE Nasdaq 100 by right V2 index, which the ETF aims to track. This index itself uses at-the-money (ATM) strikes for its underlying options. 2. Market volatility. The fund considers the current volatility of the Nasdaq 100 index, reflected by the CBOE Nasdaq 100 Volatility Index, VXN. Higher volatility might lead to slightly out-of-the-money (OTM) strikes to balance potential premium income with assignment risk. 3. Liquidity. QYLD prioritizes selling options with high liquidity to ensure efficient execution and minimize transaction costs. This might influence the chosen strike price slightly. Expiration dates. 1. Standardized approach. QYLD primarily uses monthly expirations for its covered call options. This aligns with the CBOE Nasdaq 100 by right V2 index and allows for regular income generation and strategy adjustments. 2. Special circumstances. In rare cases, the fund might consider weekly expirations for specific reasons, such as capturing short-term market expectations or managing risk during periods of high volatility. Overall, the determination of strike prices and expiration dates involves a balance of factors including 1. Tracking the CBOE Nasdaq 100 by right V2 index. 2. Managing volatility exposure. 3. Ensuring option liquidity. 4. Optimizing income generation. 5. Adapting to market conditions. While the fund primarily uses ATM strikes and monthly expirations, it has the flexibility to adjust based on market dynamics and the needs of the strategy. Question 4. How does the ETF handle potential early assignment of call options, and how might this impact its income generation? QYLD employs several strategies to handle potential early assignment of its covered call options, which can impact its income generation in different ways. Monitoring and adjustments. The fund actively monitors the underlying index and option prices. If an early assignment seems likely, they might 1. Roll the call options to new ones with higher strike prices, reducing the immediate assignment risk, but potentially lowering premium income. 2. Adjust the strike price selection in subsequent periods to be slightly OTM, aiming for a balance between income and assignment risk. Impact on income. Early assignment can 1. Reduce future premium income if the assigned shares are reinvested at a lower price than the original strike price. 2. Force the ETF to sell holdings, potentially leading to capital gains or losses depending on the purchase price and assignment price. 3. Disrupt the regular income stream if the ETF needs time to rebalance and write new covered calls. Strategies to mitigate impact. 1. Diversification. Holding the entire Nasdaq 100 index helps spread the risk of early assignment across multiple stocks. 2. Monthly expirations. More frequent expirations allow for quicker adjustments and potentially less impact from single assignments. 3. High liquidity. Focusing on liquid options offers more flexibility for rolling or adjusting the strategy. Overall, 1. Early assignment is a risk inherent to covered call strategies, and QYLD cannot completely eliminate it. 2. However, their dynamic management approach and fund structure aim to minimize its impact on overall income generation. 3. It's important to understand that QYLD prioritizes consistent income over maximizing capital appreciation, and early assignment events might impact the overall returns compared to other investment strategies. Question 5. How frequently are covered call options written and rolled within the Nasdaq 100 covered call ETF? In the Nasdaq 100 covered call ETF, QYLD, covered call options are written and rolled on a monthly basis. This means 1. New options are written every month. QYLD writes new covered call options on the Nasdaq 100 index. These options typically have a monthly expiration date, meaning they expire after 1 month. 2. Options are rolled. When an option expires without being assigned, exercised early, QYLD rolls the option by writing a new one with a similar strike price and expiration date. This ensures they maintain their exposure to the underlying index and continue generating income. Frequency of rolling EAR. It's important to understand that not all options written will need to be rolled. Only options that are not assigned by the expiration date will be rolled. The frequency of rolling therefore depends on various factors, including EAR. 1. Market volatility. Higher volatility can lead to a higher chance of options being assigned early, requiring more frequent rolling. 2. Strike price selection. Options with closer to the money, ATM, strike prices are more likely to be assigned, leading to more rolling. 3. Market conditions. If the underlying index is experiencing significant upward movement, option assignment becomes more likely, triggering more rolling. Question 6. How does the Nasdaq 100 Covered Call ETF manage risk associated with its covered call strategy, particularly during volatile market conditions? QYLD employs several strategies to manage risk associated with its covered call strategy, particularly during volatile market conditions. 1. Strike price selection. Primarily at the money, ATM, strikes. This balances potential premium income with assignment risk. In volatile periods, they might slightly adjust towards out of the money, OTM, strikes to reduce immediate assignment risk, though this lowers premium income. 2. Diversification. Holding the entire Nasdaq 100 index spreads the risk of early assignment across various stocks, mitigating the impact of any single stock's performance. 3. Monthly expirations. More frequent option expirations allow for quicker adjustments to the strategy based on changing market conditions. If volatility increases, they can roll options with different strike prices, or adjust the overall exposure. 4. Dynamic management. The fund actively monitors market conditions and option prices. They can adjust the strike price selection, roll options early, or even temporarily suspend writing calls altogether if they deem volatility poses excessive risk. 5. Income focus. QYLD prioritizes consistent income generation over maximizing capital appreciation. This means accepting some limitations on potential gains during strong bull markets, but also aiming for steadier returns even in volatile periods. Challenges during volatility. 1. Early assignment risk. Increased volatility can make early assignment more likely, reducing future premium income and potentially leading to capital gains or losses depending on assignment prices. 2. Lower premium income. OTM strikes for risk management might yield lower premium income, impacting the overall income generation. 3. Limited upside participation. Capped upside from ATM or OTM strikes means QYLD might not fully participate in significant market rallies. QYLD's risk management strategies aim to balance income generation with potential risks during volatile markets. However, it's important to understand the inherent limitations of covered call strategies in such conditions. Investors seeking maximum capital appreciation, or who are highly risk-averse, might consider alternative investment options.